One of the biggest concerns with oil going up so quickly is that it will spark a new wave of inflation across the economy and cause the Fed to actually need to raise rates again instead of lowering it. But let's put headlines aside for a minute and let's just take a look at what the 10-year is telling us. Now, the 10-year before the Iran conflict started was actually breaking below that 4% level back to last year's lows, and it had essentially been sliding for about 8 months. That was a very positive sign for the housing market, as it looked like we were going to see those rates continue to drop, and that would be a benefit for the overall economy. But since the start of the Iran conflict, we have seen the 10-year go basically straight back up to that 4.5% level. Now, the reason why that's such an important level is, as you can see on the chart above, that is where we fell from last year. That was the last high before rolling over for those next 8 months. It's a big, important psychological level as well. And this is what we want to pay very close attention to. Over the last 2 sessions, we've seen it come off of that 4.5% level and actually move back down into that range. If we're in between that 4 and that 4.5% range, we're basically in the same zone that we've been in for the last year, and it would not be necessarily a bad thing overall. But if we break above that 4.5% level, that could be a very strong headwind for the overall market, as raising rates causes the borrowing money to be more expensive and is that tightening of the overall economy. So we're going to pay very close attention to what happens at this level. If we get over that 4.5% level, we'll certainly keep you posted.